Apparently, I can just tell AI what I want and it builds it for free. My name is Mia, and I've been creating software for over a year and literally launched.
Hello, everybody. Welcome to the monthly Ask Me Anything for Asymmetric Investing. Got this out a little bit late, so I apologize for that. But in the last hour, got 10 questions just from the Asymmetric Investing newsletter community. Expect to have more here coming in on YouTube and on Twitter. So get those questions in if you want me to answer them. My plan for today is basically to just go over my 2025 results, some of the things that I'm expecting for 2026, or the way that I'm thinking about 2026 is maybe a better way to look at it. We'll do that pretty quickly, and then we'll dive into questions. So happy to hear from anybody who wants me to go through anything out there. If you're not familiar with asymmetric investing, this is my YouTube channel. And then also I have a newsletter. That's really the core of asymmetric investing, doing all my research there, and then also building the asymmetric portfolio. So I'm investing $500 a month. That can be scaled up, scaled down, depending on how big your portfolio is. But I wanted to have that be an identifiable amount of money and show how you can build wealth over time with a relatively small amount of money. So I've invested $500 a month since that began in, I believe it was May 2023. That's up to about $27,000 today. So 82% return over the past year, or over the past 2 years. Let's go to those results for 2025. This is the asymmetric investing site. If you're not familiar with it, but I'll go to 2025 returns, 34.5% in 2025, beating the market's 16.4% returns. So what I do is I have a tracking portfolio. That is something I share on a regular basis. That's from Savvy Trader. And then I actually have the real money portfolio, which is on Interactive Brokers. Long story on how I got with Interactive Brokers and why I don't necessarily share the screenshots from them. There used to be a tool that would actually track the actual brokerage, but that link broke. So, but still sitting on Interactive Brokers, but you can see there's the returns for the year compared to the S&P 500. This is on top of 2024, another good year, 35.3% return compared to 23.3% for the S&P 500. So that was another market-beating year. So for the 2 full years that I've been doing asymmetric investing, that the portfolio has beat the market. So that's exactly what I'm trying to do. And that's the investing that I'm doing in public. So hopefully that's really valuable to everybody. Let's talk a little bit about 2026. And I put this article out earlier this week, over the weekend, 5 bold predictions for 2026. And I got a couple of questions about this and how I'm investing based on these kind of predictions. One of the things when you're making content like this, beginning of the year is really interesting and really fun because you get to say crazy things about 2026 and then see how it plays out. But at the end of the day, if you're not investing in a way that makes sense based on how you think the world is going to play out, then these don't really mean a lot. But so I'm going to go through what these 5 bold predictions are and how I'm investing or not investing, maybe more importantly, based on each of these. So the first one is OpenAI will, I say, collapse. OpenAI isn't going to go away, but I do think we're at the point where OpenAI needs so much money, and not just OpenAI, but the entire infrastructure behind OpenAI, all the neo clouds. Oracle is going to have to spend hundreds of billions of dollars. There's tons of companies who are going to have to fund this build out. And there's no business model there. There's not a free cash flow positive business model. So this is all negative cash flow that they're going to have from their business. They keep talking about all these things that they can do with AI, but nobody's paying for them. The marginal cost that they're associating, that they're paying to actually build these AI tools, it is not generating the kind of revenue that you need to have a sustainable business model. Doesn't mean that AI is not going to be a big thing in the future, but I do think we're in this euphoria phase, and there will likely be some sort of crash coming up. I don't know if it'll be this year. I don't know if it'll be next year. But eventually, investors go, you know what? If we're going to spend $1.5 trillion on this AI build out, are we going to get our money back? Are we going to make money on the money that we're investing? And right now, that's a lot more uncertain than I think a lot of people think. If you're projecting out, if you look, let's be honest, OpenAI cannot predict what their revenue and free cash flow is going to be in 2026. There's no way they can predict what it's going to be in 2028, much less 2030. We have no idea what their business model is going to look like, what their revenue is going to look like. What is Google going to do? That's the other big thing that I talked about. NeoCloud's dropping is just an indication that the market is starting to be a little bit more skeptical of some of these build out companies. But Google, they can basically starve the entire ecosystem. So, how long can you go from a leader to a laggard? Just ask Perplexity. Remember when they were the biggest name in AI? I don't think many people use them anymore. Number two, the economy is going to crack. There will be a shallow recession. We will get a bear market. The reason that this is kind of a bold prediction is because of this right here. This came from Bloomberg. I believe this is about a week or two ago. While every Wall Street analyst expects the stock market to go up in 2026, when everybody thinks this is obvious, that's when I start to get really skeptical. So that's kind of one of the, I want to be a little bit contrarian, not following the herd in the market. And if you look at the price to earnings multiple of the S&P 500, for example, it's pretty high. And historically, you would see some sort of pullback. We've also seen plenty of weakness in the actual economy. And guess what? That's what really matters. I think this chart is really interesting because if you look back historically, the unemployment rate will bottom out and then it will start to tick higher. So that first derivative will go up. And then typically that's when you have a recession start. Things get worse and worse and worse. It's kind of like a snowball. I remember in 2008, probably late 2007, 2008, and then even into 2009, companies were going, hey, we're going to cut as much as we possibly can because we don't know where the bottom is. We don't know when people are going to stop spending. We don't know what's going to happen with credit markets, all kinds of uncertainty. And when you have uncertainty in business, you're just going to cut as much as you possibly can. That means that other companies are going to cut. That means people have less to spend. All of that kind of feeds on itself in these recessionary cycles. So typically what happens is unemployment bottoms, you have a rise in unemployment, and then there's eventually a top. And the top is typically where the recession ends. So we actually hit the bottom, I believe it was in 2023. We're more than 2 years past the bottom. We have ticked up in unemployment. Now, not quite in the same way that you have in typical past recessionary cycles, but there's some kind of concerning things going on. Like half of GDP growth is related to the artificial intelligence build out. 50% of consumer spending is coming from the top 5 or 10% of spenders. All these things are not necessarily sustainable long term. And so I'm just concerned about some of the things that we're assuming about the economy. And then here's the layoffs. So since 2021, the layoff trend has actually been moving up. If you have known anybody who's been looking for a job recently, job market's not great. So those are things that I'm generally concerned about. Let's go a little bit more positive. The blockchain is going to go mainstream. This is something I've been talking about for years. I've been worried about companies like Visa. That's been a poor concern to have. But we're seeing a lot more tools being built on the blockchain that I think are going to make the opportunity to build there much more efficient for businesses. If you have ever taken payments from somebody, so if you run a business, a credit card costs about 3% to take. So when you go to a restaurant, you have a $100 bill. The restaurant doesn't make $100 in revenue. They make $97 in revenue. And a restaurant typically runs on 2, 3, 4% margins. So Visa and the credit card ecosystem is basically making as much revenue and profit as the restaurant is when you go out to eat. So that's just kind of crazy. If you could squeeze out that, that's why I've been seeing more and more these added fees if you want to pay with a credit card. So you go to a restaurant and they say, hey, you know what? If you're going to pay with a card, we're going to charge you 3% for the ability to do that. That makes sense because they're making that money back that they're typically paying to those credit card companies. So as you see that more and more, then other solutions become more feasible. That's what the blockchain is all about. We've seen companies like Stripe open up some of the access to things like stablecoin payments. Those payment costs are about half of what it is taking a payment with a credit card on Stripe. So same exact infrastructure. You're just moving basically the digital rails from one rail to another rail. So I think this is all going to feed on itself. I wrote recently in Asymmetric Investing about how Coinbase had some really interesting announcements with their system update, is what they called it. So advancements to the Coinbase app and also the base wallet, which is their self custodial wallet, making that much easier to use, much easier to build things, much easier to pay for things. So I think that could be really disruptive, and I think this year is the kind of year that we're going to start to see that momentum really build. And this is, just an example, the non-trading revenue for Coinbase going up and to the right. This is the kind of exponential growth we want to build. That's why Coinbase is one of the companies that I own. There's another one that I may add to the portfolio. Just to go back, because I wanted to have the investing takeaways. If OpenAI does falter, so I do not own shares of NVIDIA. I don't own shares of any of the neo clouds. So I'm just staying away from a lot of those companies. The one company that I own that's really AI related is Alphabet. That's a position that I was starting to build 2 years ago. Done really, really well over the last 6 months. The economy, I'm buying more value stocks or stocks that I think are trading for really, really good prices. We'll probably go through a few of those today. Than looking for moonshots right now. I think that's where we're going to see opportunities. And there's also more risk in the market in certain areas. Autonomy is going to become table stakes. I've already seen there's a few questions about this, so I'm not going to spend a lot of time on this. But I think the theory that one company is going to figure out autonomy, Tesla is the one that's been saying this for a decade now, and they're going to own the world because they own autonomy, that's completely debunked. It is not going to happen. There's going to be a dozen companies, 24 companies that build autonomous vehicles. So where's the value then? It's in owning demand. Waymo is going to be one of those sources of supply, but I own shares of Uber and Lyft because they own the demand. They are the aggregator in the market. Think about you as a user. If there's autonomous vehicles in your area, who are you going to go to get access to that autonomous vehicle? You're probably going to go to Uber or Lyft. As long as that's the case in the future, that's where the value is going to accrue. So that's how I'm investing in that space. IPOs are going to be plentiful and disappointing. Remember back to 2021, we had a ton of IPOs. Just used some examples here. Robinhood, Coinbase, Rivian, Roblox, all pretty much disasters across the board. Doesn't mean these companies are bad. I own shares of Robinhood, for example, but the price that they were trading for in 2021 when they IPO'd was really bad. So if we see something like SpaceX come public in 2026, OpenAI will probably try to come public in 2026. They want access to the market. That's probably something I'm going to stay away from. So hopefully that is helpful in understanding how I'm thinking about 2026. Let's go to a few of the questions. These came in from the newsletter. What do you think about the catalyst for HIMS and Duolingo to break out of their current rut? This is always interesting because the market at the end of the day is more of a psychological gauge of what's going on with a company, with leaders, with what investors are thinking, than it is just the numbers. If you look at the revenue growth, the margin expansion for both Hims and Hers and Duolingo, I think those companies are doing really well. I think there's a lot of growth on the horizon for both of them, but investors just don't like it. So when does that sentiment start to turn? I have no idea. And this is the hardest thing about investing. This is the why I've structured asymmetric investing in the way that I have, where I'm buying stocks once a month. I'm not trying to time the market. I'm trying to just buy great companies that are going to be great 10 years from now, 20 years from now, because that short-term horizon is, Hims and Hers going to go from, 35-ish today to 70 in the next 6 months. Is that turn going to happen in 2 years? I have no idea. Same thing with when I was building that position in Alphabet. I was happy to buy shares at 15, 16, 18 times earnings because long term, over a 5, 10, 20-year time horizon, I think that was going to be a big win for me as an investor. But when does that catalyst change? I have no idea. And next year for Hims and Hers could be peptides. Maybe we see an announcement this week where is it Wegovy, where they have the new oral weight loss treatment that's on Roe, which is one of their competitors. Does that end up on Hims and Hers? That could be a catalyst. There's a lot of different things that could be catalysts. The expectations for Hims and Hers in particular, not very high going into 2026. So if they just beat their earnings estimates, that alone could be the kind of catalyst that we're looking for. Same thing for Duolingo, just steady as you go, showing that they're not being disrupted by artificial intelligence. Eventually, the market kind of flips and goes, oh, wait, this bearish case that we've been investing based on isn't happening. That's what we saw with Google and Alphabet. So maybe there's better growth potential than we thought. So hopefully that's helpful in understanding my thinking for that one. What are your thoughts on stocks like Zeta, Oscar, and Lemonade, et cetera, that have been gaining attention on Twitter and X? I've been seeing a lot of this. I've looked into each one of them. Oscar is one that I am probably the most intrigued by, and I just haven't pulled the trigger because I don't understand that business, the insurance business, quite well enough. I'm probably more intrigued by their technology and how they could potentially plug into other insurers than I am just in them being an insurance company and trying to be a little bit more efficient than everybody else. Lemonade, I've had long discussions with people on Twitter about Lemonade. That's one I just don't get how they're going to be that much different than everybody else, have that much lower costs than everybody else. There may be early adopters of artificial intelligence tools and things like that, but I can't imagine that competitors aren't going to have their lunch eaten and not respond. That's just not the way the insurance industry works. So maybe I'm wrong about that. But that's why I don't really see it. Zeta. I just don't know enough about to really have a strong opinion one way or the other. Let me pull up. We've got Fiscal AI here. Hopefully this will help with some of our future questions. And like I said, I'm going to go through the ones that came in from the newsletter first. Those are in a Google form. So hopefully I've got 10 of those. Hopefully we can run through those and then get to your questions coming in on Twitter and X. How confident are you that Uber and Lyft will be able to either forge agreements with Waymo and other AV sellers so as to make them partners rather than competitors? Please provide your reasoning. This has been, so in this early December 2024 was when I did my spotlight article on Uber and Lyft. So a little over a year ago. Also have Mobileye in the portfolio. I'll get to Mobileye in just a second. But the idea behind Uber and Lyft being better investments than companies like Tesla, and I saw that there's another question about Tesla, is they own the demand. So if you think about ride sharing and delivery and all of these things, it's all, you have supply and you have demand. And the big change that has happened over the past 20 years is we've gone from a world where supply owned the market. They had all the power. So you go back to, Kraft, Budweiser, General Mills. They owned shelf space. They had power over that shelf space. And so therefore they owned supply. You didn't realize that as a consumer because you just didn't have other options. That was just the way that it worked. My example that I give all the time is I knew somebody who was in beer delivery, and they would go into a bar. They would see a new, local craft beer. This is, 15 years ago, and they were delivering Budweiser or Bud Light, and they would say, "How many cases or how many things of that do you sell? Kegs of that do you sell in a week?" And they'd say, 1 or 2. Okay, how many kegs of Bud Light do you sell a day? And they'd say 8 or 9. Okay, if you want your delivery of Bud Light tomorrow, you're going to take that off your tap. You're not going to have that available as a supply. That completely breaks down on the internet when you can access anything, right? There's no gatekeeper anymore. Walmart is not a gatekeeper of the products that are available on the internet. The local restaurant or bar is not, the beer distributor is not the gatekeeper of what people can go buy and do because we now have access to everything and all kinds of information, and that's opened up all kinds of new business models. We see this every day, but we don't often think about the supply demand dynamics. So now the big change over the past 20 years has been the power in the market and the value in the market goes to the companies that own that demand. And when I say own demand, the simplest way to think about that is what apps do you choose to click on? Because if there's millions, maybe even hundreds of millions of people who are voluntarily choosing to open up the Uber app, the Netflix app, the Amazon app, that is those companies owning demand. That gives them more power over supply. So just look up a chart of all those companies that were power players in, let's say, 2005, all those big brand companies. They've almost all underperformed the market, and a lot of them are down overall over the past 20 years, despite the fact they still have big brands, but they don't have any power anymore because on the internet, that power that they had has just dissipated and it's gone to all the companies that I mentioned, the Netflixes of the world, the Amazons of the world. And now those companies are playing with a world of demand. So maybe it's a US company, maybe it's a global company, but you're talking about just completely different levels of scale. So that's what I think we're going to see with some of these autonomous vehicle companies. If the demand is with Uber and Lyft, and let's say there's 10 suppliers, okay? 10 suppliers are not going to build their own ride sharing networks. One might, maybe Waymo does, maybe Tesla does. Let's say both of those are both successful. They're playing from behind because they have less scale. But now you have 8 suppliers, and those 8 suppliers are going to go, okay, we need demand for these vehicles that we're making. We're building real vehicles. We're putting capital at work. How are we going to make that capital productive? The easiest way to do that is to plug in to Uber and Lyft. And that's how I think this market plays out, is that supply becomes commoditized. And the most value ultimately accrues to Uber and Lyft. That's the way that we've seen things historically play out on the internet. As long as people keep opening that Uber app before they open a Waymo app or a Tesla app, if they ever kind of get off the ground, that's why they will win. Going to Mobileye, they're in an interesting position because they would plug more naturally into that kind of a model. So if every automaker, say there's a dozen automakers, they all need to make an autonomous vehicle to basically compete in the future. How do they do that? Well, they could develop their own technology. So that's what companies like Tesla, Rivian has done that. They don't have much scale. But let's say you're General Motors, and there's a reason I'm going to say General Motors. If General Motors says, okay, we're making 2-3 million vehicles a year, I forget exactly what the number is, but it's around that. We want to get autonomy as quickly as possible. And let's say we're starting from nothing. They do have Cruise, but let's say we're starting from nothing. We can just call up Mobileye, say, hey, what sensors do we need to add to our next vehicle? Here's the autonomous features we want. Boom, everything comes off the shelf. Mobileye is a modular supplier, meaning they develop this technology once and then they can sell it a whole bunch of different times to all kinds of different OEMs. They have an announcement with Volkswagen. I think that's about 9 million units over the next few years. And then they had an announcement earlier this week, yesterday. They're actually going to be doing a presentation in a few hours. I'm probably going to cover that on Asymmetric Investing later this week, hopefully tomorrow. But they announced a new OEM in the US. My assumption was that was Ford. But the interesting thing is when NVIDIA did their announcement yesterday, they put a whole bunch of OEMs graphics up there, say these are our partners. GM, who actually had an explicit announcement with NVIDIA, was not included. So did Mobileye pick off in GM as a partner for the future? I don't know, but one of these big OEMs, and there's only a handful of them in the US, did choose Mobileye. So that's why that's my pick in that space. There's another question coming in about Tesla. Tesla has not proven the ability to actually fully autonomously drive. That's the fact. It has not proven safety beyond a reasonable doubt the way that Waymo has. They have talked about it. People in the Tesla community think that they have proven that. But if you have a critical intervention, and I mean like a real intervention where there would be a real accident every 100,000 miles. So let's say you have FSD. That would be somewhere between 5 and 10 years of driving your car. If you have an accident that would kill somebody every 100,000 miles, that is unacceptable. Just flat out, that's unacceptable. That's multiple people dying per day in a Tesla, Waymo, whatever vehicle, if the critical interventions, if terrible accidents happened every 100,000 miles. You need to get that up to millions of miles. Mobileye's stated goal is 2 failure modes, 1,000 hours each, not miles, 1,000 hours each, and they have different failure modes. So in theory, you multiply those together, you get 1,000,000 hours of operation between any critical intervention. Not necessarily a fatal accident, but a critical intervention. That is a long, I mean, you could drive around for years, for lifetimes, many lifetimes, and never get in an accident if they're able to hit that efficacy. Tesla has not shown that ability. They also have not shown that they will be able to pick off the market share that they need from companies like Uber and Tesla, or Uber and Lyft and Waymo. And the reason that's a problem is those companies have now caught up. There's more supply on Uber and Lyft in particular of autonomous vehicles than there is on the Uber app, or than there is on the Tesla app. And so the theoretical advantage Tesla always had was that they were going to be first. If they're not first at scale, then I don't know what they do. But that doesn't mean the stock's going to go down. Next question here. I'm trying to pull this in. What do you think about Target, Nike, and Sprouts Family Farm? I've not looked a ton at Sprouts. I'm interested in Sprouts, but have not done the work to have a really strong opinion. Target, my wife works at Target. Target's headquartered, a few miles from my house. So very familiar with Target. They've got their own issues. Target's an interesting one because I do think there is, look, I'm a parent. If you're a parent, you understand that Target just has a place in your life. Like, you need diapers, you need them right now. You don't need them in 2 days. So Amazon doesn't really answer that question. Them trading for, I think it's right now 11, 12 times earnings. That should be really compelling, but I'm not necessarily certain that their old management was basically replaced by essentially the same management. The COO became the CEO. I don't think a lot's going to change at Target. So I do think things do need to change. I would love to see them move into autonomy more. I want to see some autonomy announcements from Target. They have a delivery service that we use all the time that just on its face makes no sense. Makes no sense. Their app is much harder to use than DoorDash. I think has the best interface. So Target's app just kind of stinks compared to that, just the way that you can add items. And then why is it that I'm getting asked to tip somebody who's delivering my stuff when I'm paying a subscription fee to be part of Target Circle or whatever it's called? That just doesn't sit well with me as a consumer. And so I think they've got some stuff to figure out. I wish they would make bigger swings, but they haven't. So I think I own some shares of Target, but not one that I'm super excited about. Nike, look, you look at Nike versus On Holding. On Holding is a company that I cover all the time. It's one of the biggest positions in the asymmetric portfolio. I don't see any reason to own Nike over On Holding. On Holding's 3-year growth rate is 40%. Their price to sales multiple is double what Nike's is, but they're growing at 40%. Nike's revenue is shrinking. The other thing is look at margins. On Holding's gross margin 60%, Nike's is 40%. I could see a future where we look back and Nike in 10 years looks a lot more like Under Armour does today than Nike does today. Like, history says that these fashion companies can't maintain their top position for decades. Nike has done an amazing job doing that. I just think that's not what the future is going to look like for them. Again, could be wrong. Here's a good question about why I don't invest in semiconductor stocks. So I don't own any NVIDIA, AMD, TSMC, ASML. TSMC was one that I was very interested in. When I first started the YouTube channel, it was one that I covered just as I think I called it like the no-brainer play in AI. That turned out to be pretty right. The biggest reason I don't own a lot of these companies is I don't offer anything differentiated as far as an opinion goes that you aren't going to get. If you want to cover those companies, Jose Najarro does a really good job. Nick Rossalillo and his wife do a really good job following those companies. That's the world that they live in. It's really hard to follow every piece of the market, and semiconductors is such a complicated space that unless there's something really obvious, one of the top stocks I had in 2025 was Micron. I didn't buy it for the portfolio, unfortunately, but that was one where you could just see like memory was going to be a big deal. Micron was a big player, but unless there's some sort of really simple, stupid solution, I just am not the person to be adding value there. So we're all going to have our areas of expertise and differentiation. That's one that I've just stayed away from because I don't think I add anything really great there. This is a longer one, so I'll just read some of this. I'm pretty Travis, you're pretty bearish on Tesla. My question, have you used or driven FSD? The technology is pretty amazing. I've been on trips combined thousands of miles without intervention. Also, Waymo's cost roughly $150,000 to produce versus the Cybercab costing $15,000. Don't I don't think there's any evidence that they're actually going to produce those at $15,000. But also, Waymo cost customers $2 per mile, only 20 cents per mile for Cybercab. Again, don't believe anything that any of these companies are putting out as far as their cost today. They're not making money if they're charging 20 cents a mile. Given these factors, do you believe Tesla has a serious advantage to FSD? I mentioned some of this earlier. FSD can be amazing, and it can also be not good enough to be fully autonomous without a person driving the vehicle. There's a number of really concerning things coming out of Austin. One is that the accidents that they've reported to the NTSB, I'm going to forget my acronyms. They've redacted all of the important information. So what happened? There was a safety driver in the vehicle. There was still an accident. What happened? What was the disengagement? We don't know any information about that. If you go in, California actually has every company needs to report all of their disengagements or accidents. You can go in and you can see all the just goofy things that Waymo has to report, and they do these detailed reports. Like I just started going through them individually, and it was like a biker ran into a parked vehicle, a sign fell on a car. It was just like weird stuff that they still have to report. Tesla, we're not getting any of that information. So if they are actually going to be trustworthy, that full self-driving, that FSD can drive for millions of miles without getting in accidents, without running over kids, without doing all the terrible things that people are worried about with autonomous vehicles, they got to prove it. And they've got to show the data, not a chart that has biased data because you have a safety driver. I mean, like you can't tell me that FSD is safer and then also say you have a person in the vehicle. Because if your FSD vehicle starts to drive off the road, you're going to intervene. And if you have to intervene once every 100,000 miles because your car's driving off the road, that's a problem. And you're not even going to notice that. You as an individual are not going to notice that until you're because that's an outlier. That's the long tail. That's what they have to answer. Elon Musk responded to something today, basically saying that, I think somebody said that a bunch of competitors are catching up. And he said, the last 1% is really hard. Yeah, it is. That's the point. That's why Waymo has more sensors. Okay, on the Waymo side, and this could go for Waymo, this could go for Rivian, this could go for Mobileye, any of those companies. What we have always seen, you have two choices with autonomy. You can solve the cost problem first and then figure out the tech, figure out safety. That's what Tesla has done. They said, hey, here's this low cost vehicle. It's got 2 seats. We can make 1 million of them. We got cameras. It's pretty cheap. We'll figure out the tech later. Or you can answer the tech problem first, make sure it's safe enough. So this is the Waymo strategy, and then cut your costs. Throughout history, what has always been consistent is that technology costs have come down dramatically. Look at the cost of a LiDAR 5-10 years ago. You're talking $10,000 10 years ago. Now a LiDAR is like $100. Why not put a LiDAR in your car? That $150,000 number, that is bespoke vehicles. That is a small number of production. I, I just, they're not going to get, Waymo is not going to get to the point where they're scaling to making 100,000 vehicles a year, 200,000 vehicles a year, and they still cost $150,000. They're going to be $50,000. They're going to be custom made. Have you seen their Zeekr vehicle? I think they're testing that now in the US. So we'll see if they're able to bring that over without tariffs and get some sort of carve out there. But that's a custom made vehicle. That would be, I would assume, something more like $30, $40, $50,000. And all the hardware and technology is integrated into the vehicle. That's what we're going to be in the future. We're not going to be these, goofy looking things with like the hats on the top. So assuming that the costs today are going to be the same as the cost tomorrow, I think is a really poor assumption. You have to assume that those costs are going to come down exponentially. And Tesla has not answered the question of can they actually make a vehicle that's safe enough without a safety driver? They simply haven't. Again, I have been saying this for years, and I have been getting negative comments saying that I don't understand FSD. Oh, well, have you driven FSD? Yeah, I've been in FSD. It didn't handle the roads that had a little bit of snow on them in Minnesota. It didn't. It couldn't stay in the lane. I tried to change lanes, couldn't change lanes. It's just not good enough. If it was good enough, they would have launched it at scale. It's not good enough. Sorry, I have opinions there. Okay, I'm going to try to paste this whole question. We'll see if I have enough space here. Getting hungry. It's cut off a little bit, but I'll show what I can. In your newsletter, you talked about pullback related to overspending on AI. These pullbacks tend to affect the broader market, even quality stocks. How should I think about buying into weakness versus waiting for the pullback? I like Google, but if it's going to take a 10% hit when OpenAI collapses, why not wait then? First of all, a 10% move is probably not worth waiting for. Let me try to pull up an example stock here. All right, let me share this. Here's a good example. Okay, so this is Robinhood stock. I think I did my spotlight on them somewhere around here, April, May 2024. And I just steadily started buying shares. Now, if you're buying shares, let's say you buy shares here at 28.21, and the next day it drops down to $24. Did you make a mistake at 28.21? Well, since then you'd be up 340%. Yes, your gains would have been better if you would have bought at this low, but what if you missed this couple of days here and suddenly the stock's trading for 33? This is one of the reasons that I've built the portfolio the way that I have, where I buy stocks once a month and I'm just trying to make the best decision I can every single month. I'm really, really trying to take out this timing the market piece, because this is what we get. We focus on this and we miss this. Like, if you have a stock that you think can 10x in value over the next 10 years, saving 10% just it doesn't matter. It really, really doesn't matter. And you know what? If you buy some here and it goes down, like let's look at Duolingo. So here's one that I've been adding recently, and it has been going down. Okay, so let's go to 6-month chart. Okay, I forget exactly when I started buying, but it was I think it was around $200 per share. No, I think it was above that. It was probably in October or November. So it's probably November 1st that I bought first, $265 per share. Okay, then the stock drops, it tanks. I'm just buying a little more. I'm just going to add a little bit more because I still think in 5-10 years, this is going to be a company that could be really valuable. It doesn't mean that I'm not starting with a 10% position in my portfolio. I'm starting with maybe a 1% position. And then maybe it goes down. Maybe I go to a 2% position. Maybe now I'm adding conviction over these next few months. So I get to go to a 3% position. That's the way that I'm slowly adding over time. And I really, really caution people from focusing on trying to hit that perfect point, because you're never going to do it. But if you end up saying, you know what, I thought about buying, let me actually show you the perfect example. I'm not going to be able to find it. Somewhere almost 15 years ago now, there is an article on the Motley Fool that I wrote that said, here's why I'm buying shares of Tesla stock. Tesla stock at the time, this was before any splits, was trading for, I want to say, about $20 or $25 per share. There's trading rules at the Motley Fool where you can't buy stocks then for 2 or 3 days. In that 2 or 3 days, the stock went up to $30 or $35 per share. And I just said, you know what? I'll just wait till it comes back down. Never came back down, ever. That position that I was going to buy then would be worth probably several $1 million today. Don't worry about the 10%. That I think is the biggest thing. If there is a pullback and everything comes back and a company that you like at $100 a share is now trading for $90 a share or 80 or 50 or 60, just buy more then. Hopefully that's helpful. Do you consider Spotify a market beater from here on out? So here's my transition with Spotify. Spotify was the first stock that I covered on Asymmetric Investing because I saw the potential for that company to be an aggregator of demand in music and podcasts. The other thing that was going on at the same time is they were cutting costs, and you were starting to see the start of operating leverage. I mean, I'll pull up the info here so you can see it all. But the market just didn't see this yet. And what often happens is a company like Spotify, investors go, you know what? And Ben Thompson wrote this on a regular basis. I'm going to do their operating profit. I think that'll be the best way to show this. So let me share this. So this is the trailing 12-month numbers. Okay, so asymmetric investing starts basically right here. Okay, they're losing money. In fact, their losses are growing, despite the fact that their revenue is going up. But there's a couple things that were happening in here. They had I think 3 rounds of layoffs in Europe, and in particular, there's a cost of social charges that they call related to some of those layoffs, and they were absorbing those costs here. But you could start to see their operating leverage was starting to tick up because their operating costs, if we pull that in here, so SG&A and R&D expenses. Okay, so I'm going to stack those together. I'll hide the other two. These hit an inflection point in June 2023. So Spotify has been growing revenue, but their operating expenses have been in decline over that period of time. That's how you get this in operating profit. Same chart if you look at their if you look at their free cash flow. So do I think that they're going to be a market beater from here on out? The thing that I'm most worried about with Spotify is their growth has slowed. It's just a little less compelling to me. The 3-year growth rate is 14.5%. That's all right, but you're not going to have the same operating leverage trends. So the things that I always talk about, the 3 ways that stocks are going to go up is revenue growth, margin expansion, and multiple expansion. Okay, the other piece is their multiple, their price to sales multiple. Let me grab that quick. Has gone from in early January 2023, it was 1.2, and now it's 6. So a massive part of their stock gain has been multiple expansion. Another piece has been margin expansion. The smallest piece of their stock gain has been revenue growth. So will it be a market beater from here on out? Probably at the right price, but I'm less comfortable owning the stock at 75 times earnings, 43 times forward earnings. Even on a forward basis, price to free cash flow is 28. I'm just less excited about it. I believe I sold a little bit of my Spotify stake in December. May consider doing that again. I like the company. I don't like to give up on companies. I want to over index to not selling, but that's kind of where my head is at with that one. Let's see. There's one asking me if I've seen a video, but I don't see a link to a video. So if that is you, send me the link and I will get back to that. Question from Jimmy. Well, when will the stock market crash? And what stocks should I avoid? Which stocks should I avoid investing in that seem good other than Nvidia? I have no idea when a crash is coming. Again, timing the market is not something that I do because I don't have an edge there. So long-term investing is what I do, because if you can think 10 years out, the market typically can't do that. Hedge funds can't do that. Mutual funds can't do that. Most individual investors are just unable to think that far out. So that's the why I'm not going to predict a market crash. What I've done in asymmetric investing is I've said that if the market goes down 20%, I'm going to double the amount that I invest each month. If it goes down 30%, it goes up 1.5x. So from 500 to 1,000 to 1,500 and so on. That's how I want to show that being aggressive when the market is freaking out. Be aggressive when everyone else is fearful. Be fearful when others are aggressive or are getting greedy. All right, I'm going to go to some of the questions that came on from LinkedIn and also on X. Well, what do you make of the Finnish company claims their products? They're in production for the solid state batteries. Solid state batteries are really interesting from a technical standpoint and from a theoretical standpoint. Any one of these companies, and I've been through these cycles so many times, especially I follow the solar industry for a really long time. That includes batteries and hydrogen. Show me the money. Show me that you can do it. Show me that you can do it at scale. Show me that you can do it profitably. Until we see that, I'm just going to be skeptical. Doesn't mean that they're not right, but that's not the game that I'm playing. I want to have the companies that I can see that compounding work for me over a long period of time. In your bear market predictions, you say cracks in the economy based on jobs. However, the biggest factor has been government jobs, tailwinds being tax breaks. Why the concern? It is partly government jobs, but it's also private sector jobs, and then what those private sector jobs are. So it's also really murky data over the past 3 to 6 months since the government shutdown. So if you want to take a positive spin on the data, you can make that argument. If you want to take a negative spin, you can make that argument. What I'm saying here is, with the market at all-time highs from a PE perspective, from an absolute value perspective, I think there's a lot of optimism already priced in. And if we get any of these sort of negative things, and look, you have to have seen it, whether it's people that in your life who have lost a job and have been looking for another job, probably aren't finding as good a job as they had before. Companies just aren't hiring like they used to be. It's just, I don't think it's as nearly as bullish as a lot of people like to think in the market, because, and again, this is maybe a piece of me living in the Midwest. I'm not seeing what you're seeing if you're in California or if you're in New York. So maybe we have different views on the world, but this is a pretty balanced place to be. And if things are tough here, usually we don't have the high highs. We also don't have the low lows. So I'm flagging that as something to keep your eye out on. Can I take a look at React's stock? Not one that I have ever looked at. So just want to mention that. Is Tesla still asymmetric? I think I've highlighted a lot of that here already today. I don't look Tesla. Let me pull up the Tesla's enterprise value to sales is 15. Their price to earnings multiple is 302. I'll share my screen here because I think this is. Look, let's just talk about the reality with Tesla. I'm going to pull their trailing 12-month numbers. Now, we don't have the Q4 numbers, but look, their revenue peaked. It basically started to deteriorate in December 2023. If we go and pull their deliveries, that peaked in December 2023. Asymmetric companies are not shrinking, and Tesla is shrinking. Yes, they're telling a big story about autonomy. They're telling a big story about robots. They have not proven. Elon Musk has been talking about autonomy for a decade. This is a what's the valuation right now? $1.5 trillion company. This is one of the biggest companies in the world, and they will probably have a net loss this year and probably negative free cash flow. So, sorry, no, I don't think they're asymmetric anymore. Have I ever looked at bullish engulfing when you buy stocks? It seems like complete bunk to me. Guessing you may agree, but just curious. I've never heard of the term bullish engulfing. So I'm gonna have to look that one up. CPNG, I believe this is Coupang. Yeah. Company had a data breach last month, which led to taking a big hit. CEO has been replaced, and the company has pledged $1 billion in compensation. Buying opportunity? I don't know. And maybe this is a good opportunity for me to just talk about some of the areas that I don't invest in. Coupang is primarily in South Korea. I've never been to South Korea. I don't live in South Korea. I don't know how I would build strong conviction in a company that I can't even try their products. So no, I don't have strong conviction. There are plenty of other people though who I follow and respect who do really like Coupang. So but that's just my thoughts. I couldn't give you a really strong argument why this is a great buy or a great sell today. Thoughts on energy generation manufacturers like GE Vernova, Caterpillar, Solaris, high demand, even if less data centers get built out due to the slow utility process. That could very well be the case. And GE Vernova, I think, has been a phenomenal performer over the last year or two. One of the things, this is where if I were to say, you know what, I'm going to invest in any stock in the market, value stocks, things like that, then maybe I would be more interested in some of these. The fact that I explicitly state asymmetric investing and I want to be able to see a 10x opportunity over the next 10 years, that just generally keeps me away from a lot of these high capital expense companies, these manufacturing companies. So that doesn't mean that these aren't going to be great investments. I think GE Vernova in particular has gone on quite a run and is now worth $185 billion. Forward price to earnings multiple is 57. That's where, enterprise value to sales is 5. This is still fundamentally a manufacturing company. They're producing electric stuff. That's a really, really high price for some of these companies. So a lot of times with these kind of older, this is a huge part of the AI trade that I think people don't really quite understand right now. Is if we do have a pullback, go back to my earlier discussions about my expectations for 2026. If we do have some sort of pullback in the spending for artificial intelligence, it's not just going to be Nvidia that's going to be impacted, or AMD, or companies, Oracle, companies like that. It's going to be companies like GE Vernova. It's going to be companies like Comfort Systems. These are companies that have massive, massive tailwinds because of the artificial intelligence build out, not just because there's more demand, but because they can charge whatever they want. If you want to move up to the front of the line to get your Comfort Systems installation done, they just go, okay, instead of having a 10% operating profit on this project, we want a 50% operating profit. And you know what? Amazon, Google, all those companies go, all right, fine. As long as we can get this done 6 months earlier, charge us whatever you want. Just the reality of the market. Look at those companies' operating margins over the past 10 years, and you'll see this massive bump since this AI build out. started. So don't think that that's going to be the case forever. Don't think those margins are probably going to normalize. I think this is out. Yeah, ALAB, CRDO, INOD. What do you think about Micron? Is MU? Again, not my area of expertise. So Micron is one that I think was an interesting opportunity early in 2025, but that was when shares were trading for like 8 times earnings. Micron today, very different business, and this is a very, very cyclical business. So now the price to earnings multiple is up to 30. Enterprise sales to sales is 8. Let me just I'll pull this chart up to just show you what I mean by cyclical. And I'm going to pull in, let's pull in operating margins here too. So you go over history, boom, bust, boom, bust, boom, bust, boom. You can guess what happens next. Is this time different? Maybe, maybe not. But this is one of those. I'm not jumping in front of a bus on Micron when it seems like I could easily make the argument that it's probably hit the peak for investors. Have I ever looked at Minneapolis-based Winmark? No, I have not. Sorry, maybe I'll look at it right now. That's the food company, right? Retail store concepts. No, I haven't. I'll leave it open. Plato's Closet, Once Upon a Child, Played Against Sports, Style Encore. Probably not my cup of tea, but I do like a good Midwest company. What do you think of Reddit? One of the articles I want to rewrite and update in 2026 is related to the smiling curve. And this is, again, one of the concepts that I go back to over and over again on asymmetric investing. And the smiling curve is basically, in the old world, in the supply-driven world, where the constraints were typically geographic, you would have just a scale curve. So the company that could reach scale could have lower costs, then you have more revenue, you have more money to reinvest in the business, blah, 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 blah. And if you don't have that scale, you just can't compete. What the smile is on the smiling curve is there's now somebody like me. I can distribute on YouTube. I can distribute on a newsletter. So now I don't have to be Goldman Sachs. I can just be me. I can have a very low cost structure and I can build a niche business. So what ends up happening is these technology companies, if your business is a scale business, the one with the most scale wins. So just look at anything from the user numbers to revenue per user to free cash flow to revenue overall. Stack all of your social media companies. Facebook, Meta wins. Everybody else basically loses and is not a good business. Reddit is in a unique position because they're getting paid for their data, basically for artificial intelligence. I don't know how sustainable that is. But I don't, and I also don't I don't understand how they're going to maintain their momentum. But maybe they will. Again, I'm very well may miss that one. But right now, I just don't love the social media space unless you're buying the leader, which would be Meta, at a really good price. So maybe wrong on that, and I have been, I think, since they went public. What are the best metrics to value smaller companies with really high growth? And what do you typically look for in these companies like Zeta? I gotta figure out how you actually say this. Okay, let me just pull this up because I'll show you how I look at some of these investments. So a company like this, you can see negative 174 price to earnings multiple. So that tells me that, they're not making money, but they're obviously growing really quickly. I'll layer in revenue growth rate, and then let's look at operating profit. That's what I've been using consistently here. Okay, so the things that I like here, I'm going to do trailing 12 month. Here's what I like. We've got really good revenue growth, consistent revenue growth. I get a question about why this is coming down over the past couple of quarters, but again, I don't know the company, so maybe there's a good answer for that. But you're getting operating leverage, so operating margins are improving. This is, oftentimes when stocks kind of take off, and I think we've probably seen that over the past few days with Zeta. So, how do you value a company like this? Because there's no E in price to earnings multiple. The first thing that I often look at is the price to sales multiple. This is not typically something that a lot of investors like to look at because price to sales doesn't tell you anything about their profitability. The reason that I like it is it's a better gauge of, okay, if this company keeps growing and eventually you get to some sort of theoretical margin, then you have a better idea of what your opportunity is. So, for example, they trade for 4.6 times sales. I'm going to use a different comparison, but okay, let's just look at some of these. Okay, growth rate 30.5% over the past 3 years. Gross margins pretty strong, 60.8%. Okay, let's look at a stock that I own, one that we talked about earlier, Hims and Hers. Okay, their enterprise value to sales is lower, but their growth rate is faster and their margins are better. So again, it's hard to compare price to earnings multiples for a lot of these growth companies because oftentimes you're not optimizing for earnings yet, you're optimizing for growth. That's why you like to use the price to sales multiple or enterprise value to sales multiple. And then you can look at, okay, what's that multiple? What's the revenue growth? Does this sort of fit into a framework where I would be interested in researching this company more? Zeta, I think, falls into that. I got to look into it a little bit more. Like somebody said earlier, it has gotten a lot of attention on social media. So I'll check it out. But then you got to, I want to see all the strategy advantages that I always like to see in investment in investing. So that's where I, have stayed away from companies like Lemonade that people, really were pushing on me. I don't know. I just didn't get it. But that's how I think about valuation for some of these smaller companies is oftentimes price to sales multiple is more valuable because eventually they will get to those more mature margins, but they're typically not there when they're young, small, growing. So hopefully that's helpful. It's not always apples to apples, and sometimes if you find a great company, don't overthink valuation. Amazon, Netflix, Tesla, go through any company that has gone up 10x, 20x, 100x, Nvidia over the last 20 years. Valuation, they were almost always overvalued by most traditional metrics. Any idea on stocks like Adobe and Atlassian as an AI bubble hedge or potential bubble hedge? I think was the second comment they made. I don't know about those as hedges for the AI bubble. I think the question there would be, are their businesses going to be helped or hurt by AI? My bias here, I hate every single Atlassian product that I have to use. Just hate it. I just like that company I would never own it just because I can't stand any other products. That's my bias. But Adobe is a different story. Adobe's stock has come down. I did some videos a while ago about saying, hey, this stock is crazily valued. I don't understand why people are buying Adobe. That actually turned out to be right. The question now is, has the stock fallen enough that it's attractive? And what does the future look like? The thing that I would be concerned about with Adobe in the current drawdown, 51%. So now you got a price to earnings multiple of 20 on a trailing basis, 15 on a forward basis. That's a pretty good valuation. Revenue growth is only about 10%. Most of that revenue growth is coming from increasing prices on existing users. The question that I have for them would be, look, I use Canva. Is products like Canva going to eat their market share? And typically companies get disrupted from below. They don't get disrupted because somebody comes up with a better product of the thing that they're doing. They get disrupted because somebody does something simpler, easier that the incumbent just doesn't want to do. So could Adobe make Canva and charge, $10 a month for it or whatever it costs? Sure, they could, but they don't want to because they're charging 10 times that for professional products. That's how you get disrupted. Is you can't respond because your business model just won't allow you to. And what we've seen is that the growth from users goes to companies like Canva. Does that eventually start to be a problem for Adobe? That's where I think investors. That's what investors are thinking about today. Um, I think they could be just one of those companies that bumbles along for the next 10 years, and people go like, "Hey, this is still the standard for professional, creative tools." And if you're making a movie or if you're doing, high-end graphic design works, you're still going to be using Adobe products. But there's a ton of you're going to be able to do with Gemini or ChatGPT or Canva, tools like that. So I don't know. I don't see the 10x potential, and that just makes it a stock that I'm not gonna be buying today. Am I still buying shares of Hims? My recent buys for January went out on January 2nd, first day of trading before the market opened, and yes, I bought shares of Hims. Um, So if you don't mind me asking, does the portfolio shown on the site reflect your primary investment portfolio, or is this more of a model portfolio alongside others you manage? This is not all of the money that my family invests, but it is indicative of. I mean, the other brokerage accounts that I have own almost all the same shares, so it is the way that I invest always, whether it's myself, whether it's the money that I help manage for family members. The stocks that I'm researching and that I like are the stocks that I buy for them. Same thing with my kids. My kids are starting to make their own decisions for themselves, but they're still typically swimming in the same pool that I'm swimming in with asymmetric investing. So not exactly the same. And the reason that I built a portfolio that I did is I wanted to show how you could start from zero. That portfolio started from nothing, and now I want to show. I want to be able to in 10 years. I want to be able to say, "Hey, look, this is worth $500,000, $1 million, whatever it gets to," and say, "This started from nothing. You can build wealth in a relatively short period of time." And this is how I did it. I did all of it in public. So that's the idea behind it. But the stocks that are in there are the same things that I'm investing in typically. Maybe own a few shares of Target here and there. But most of the stocks, most of the portfolio is the same exact stuff that I own in my personal accounts. I own shares of Crocs, and they're all down. Bought various times within the past 2 years. My timing in Crocs is it just not a great stock. Crocs has got a lot to prove over the next, I'd say, 6 months. It could be that it's a phenomenal value stock if they keep buying back debt and stock, reduce their shares outstanding. But they had some concerning outlook in the past couple of quarters. So we'll see what that fourth quarter looks like. That's always a really, really critical quarter for most of these retail companies. I don't have a great answer for you there because I have the same questions. This is why I have not been a huge buyer of Crocs recently, even though it's in the asymmetric portfolio. But so I'm just kind of sitting there and holding it. That sometimes that plays out okay. I did that with Owlet. I did that with Celsius. If we can do our Celsius advertisement here. And it worked out well. But those uncertain times where I just didn't know, I just kind of let it be. Is Hims cheap? I'm buying, by the way. And then there's another question. What do you think about Hims Q4 2025 revenue and 2026 full year revenue? I don't do guidance. I don't do guesses at what revenue is going to look like. The only reason I use any analyst estimates is because that's typically what a lot of the big money investors are kind of using as the bar. Okay. Do we think they're going to beat or miss that? I think over the next 5 to 10 years, this is a company that can continue to grow at a tremendous rate. I mean, growing I think their 3-year growth rate is 70%. Even 40% over the next 10 years would be incredible. Like there's almost no way the stock's not going to 10x in value if it goes up 40% a year. And that would be a deceleration from their current growth rate. So I don't know what Q4 is going to look like. I don't know what 2026 is going to look like. But I think that they're, trading for, what is it, 3.2 times sales historically, companies that are growing this fast. I mean, look at Palantir. Palantir trades for like 120 times sales, and they're growing more slowly than Hims and Hers. So you have the opportunity, go back to those three things that I've talked about. revenue growth, margin expansion, and multiple expansion are the three things that are going to drive most stocks higher. Hims and Hers has all three of those in spades. Anyone who tells you when they know when the next crash is coming is lying. That's 100% true. Not sure it was covered, but thoughts on gold and silver miners despite the runs in 2025. Their PE and PEG ratios are silly cheap. Unless you know everything there is to know about gold and silver miners, this is not an area that I would touch with a 10-foot pole. It is full of like if you see my inbox of Canadian miners who want me to who would pay me to do videos pumping their, micro cap stock, it is insane. And I don't like the industry. If you want exposure to gold and silver, buy gold and silver. I think, my friend Lou Whiteman said that recently. I think that's just the way to go. Do you think the new chief marketing officer at Portillo's will be able to reverse the trends in the less profitable locations? I hope so. The other thing that I'm thinking about a lot with Portillo's is if everybody's on Wegovy and we get these oral treatments and that's a hit product, man, is that why all these restaurants are in the dumps right now? I don't know. I still think, I believe I bought a little bit of Portillo's recently just on usually these cult following companies are a little bit more predictable. It just it seems like there's execution challenges. There's, did they expand in certain areas too quickly? Did the CEO and CFO not, kind of know what they were doing when they started expanding so much outside of Chicago? All of that could definitely be the case. They've got some really, really good people on the board of directors. Jack Hartung came from Chipotle, was one of I think he was CFO, COO there. It's one of those stocks that they may do nothing, and we may look back in 10 or 20 years and think that this was like such an obvious buying opportunity. Again, asymmetric investing. The great thing is, if I'm right, you can make 10x or more your money. Your upside is unlimited. If I'm wrong, the most I'm ever going to lose is whatever I invest in a company. So that kind of fits the bill there. I'm intrigued, but they got a lot to prove in 2026. Mara, not one that I follow. So I'm staying out of companies like Iron. I just don't see the sustainable business model there. Peter runs a related question on charting in his books. He shows a chart, both earnings and stock price. Where can I find something like that? I use Fiscal AI. So if you want to try that out for 2 weeks, fiscal.ai/ASYM. You can make all those charts. You can pull up, typically stocks do follow their revenue growth. So you can look at that long term. I'm on the enterprise version, so that's got 20 years of data. I think the pro version is like 10 years of data. But yeah, that's typically how things go, is you want to follow revenue growth if you want asymmetric returns. Am I still bullish on Mobileye? It's been selling off aggressively over the last few months. Yes, hopefully I explained most of that earlier. The other announcement, their announcements this week will be interesting. And like I said, if you are a subscriber, I'm going to send something out hopefully tonight or early tomorrow about their presentation that I believe starts in an hour or two. So typically that's when they kind of talk about, they always do this keynote at CES. We'll see if we learn anything new, but the fact that this partnership with a US automaker came out yesterday, I think was positive news, because we need to see more of those announcements. You need to see this be something where you're not only maybe you're maintaining the number of units that you're selling, but if you didn't know this, their average unit price is about $50. So if they're selling full autonomy systems, so their drive system, that's more like $10, $20, $30,000. So the opportunity for Mobileye is they're selling somewhere around 25 or 30 million units a year. Even if those number of units decline, if your revenue is going to go up 10x per unit, which it's going to be something like that. I published it at some point, kind of the ballpark revenues for things like their surround ADAS, which is what the deal was yesterday, chauffeur, and then all the way up to drive. But the revenue numbers go up really, really quickly. So we'll see what Volkswagen does. They're launching theoretically in Los Angeles this year through Moya. Moya is the like Volkswagen subsidiary that's doing full autonomy. They're using the Volkswagen ID Buzz. I think that's actually a phenomenal ride-sharing vehicle if you've ever been in one of those. But we'll see. Again, asymmetric potential. If I'm right about that one, 10x. I mean, let me look at the current market cap, the current enterprise value, $6.6 billion. They've got, $1.5 billion or so in cash on the balance sheet. I like that asymmetric potential with the company. Again, if I'm wrong, most I'm going to lose is the amount I'm invested. If I'm right, this could easily be one of the huge winners over the next 10 or 20 years. What's my opinion on Circle? How do you compare it to Coinbase? Fun fact, the USDC token was created 50-50 by Circle and Coinbase in 2023, I think it was. They made an agreement that Circle, which was then still private and Coinbase was public, Circle would take over running the USDC token. Coinbase would take all of the revenue from the USDC token. So the token itself is backed by assets that are then earning interest. So they're investing in things like treasuries. So that interest that they're making, 100% of that interest, minus I think a small operational fee, that is on the Coinbase platform. So in Coinbase wallets, on the Coinbase app, look at all these tools they're building with Base, things like that. All of that is the Coinbase platform. Coinbase keeps 100% of the revenue. Everything else, they split 50-50. So in other words, Coinbase makes more money on the USDC token that Circle runs than Circle does. Sounds crazy, but that's true. So I own Coinbase. I don't really need to own Circle. If Circle got to a valuation, I actually was lucky enough to get, I think, one share of Circle's IPO, if I remember right. So did get that nice bounce, but it's got a $20 billion market cap today. I mean, it's down from, it's down 70%. Maybe it's one that I should look at again. But I want to have a really good valuation because everybody and their brother's coming out with a stable coin right now. So I don't know that that's necessarily going to be a huge differentiator for them. And especially if they have to start paying interest. What do you think about PayPal? I don't know. I want to like PayPal. I just don't. Same thing with Snap. Snap is one that is, I think, a perfect example of the smiling curve. How in the world do they ever catch up, generate a similar amount of revenue per user as a company like Meta? I just don't see how that's going to be possible. I just rather own really great companies that we know are really great companies. PayPal could be that. I don't know. It's such a competitive space. There's another question there. I just want to acknowledge that. We are getting towards the end here, guys. I'm running out of steam. Thoughts on software companies like FRSH? Have not heard of that one. So, sorry, I got a punt on that. Mercado Libre is a stock that I own. Again, I have a hard time buying stocks that I can't actually try their product, but I knew enough people that had lived in South America, and they're like, they own everything. But I don't have strong opinions about what's happened in Venezuela or the Brazilian elections and how it's going to impact Mercado Libre. There's probably other people that would be able to answer that better. Portillo's, could that recover in 2026? Hopefully I answered that a little bit earlier. I do not have a Discord channel. Been thinking about, is there a way we could do some sort of more community features? Haven't figured that out. I don't love Discord. I know that other people do, but thinking about it, but have not done that yet. That would be kind of like an add-on to the newsletter, but nope, not quite yet. So, but stay tuned. If you're part of the newsletter, you hear about that. What do you think about Rocket Lab at the current valuation? I'm not buying it as current valuation. It's just, I mean, man, we're up to $42 billion market cap, 74 times sales. I get how this is going to be one of those companies that could be a leader in the space. I just don't know what differentiates them. I don't know. I mean, I guess I could make the argument what differentiates them. I don't know in 10 years, 20 years, are we going to have, 10 of these rocket companies? Maybe. Um, is SpaceX going to come out and, suck the oxygen out of the room from this company? Maybe. I don't know. Again, there are areas where I'm willing to say I just don't know what the future looks like, and this is one of them. Same thing. I'm not a coffee drinker. Um, and but David says I live in Tucson and Portillo's is kind of hurting here in Mexican food mecca, so to speak. So yeah, but Bros, which is I believe Dunn Brothers or Dutch Brothers. Uh, I don't know. We don't have those here. So again, can't can't really comment. And I'm not the coffee drinker in the house, so I've just kind of stayed away from that space. What's the elevator pitch on Owlet, and is it a buy right now? Where they captured 40% of all dollars that are spent for baby monitors. The simple story with Owlet is they are the one FDA approved baby monitor. So it's this little sock that goes on your foot. We used it for all three of our kids. I think it's great. I know there's research that says that it makes parents more anxious. I don't know. I want the data. I want to know if my kid's not breathing in the middle of the night. It only went off a few times, especially with the newer model for us. The older one was easier to kick off, and if it got was kicked off their feet, it would alarm and wake everybody in the house up. So that wasn't as much of an issue, but they've now bundled with monitors, which is really interesting. The real upside potential is if this becomes a product that goes home with you with your new baby. So if you've had kids, at the end you go, do you want a breast pump? And you go, yeah, sure. They write a prescription. If you're having a baby, you've already hit your max out of pocket. You might as well take the prescription. It's the way the healthcare industry works here in the US. And so they send you home with a breast pump. Same thing you can buy at Target, just cost probably 3 times as much. The idea is that Owlet could potentially be that same product. I had to bring my baby into the emergency room. He was sick. They checked his oxygen, and I was like, "We have one of these at home, and here's what it was." And the guy's like, those are terrible." The reading was exactly the same. It's literally the exact same technology that they're using in the hospital. So I think it's democratizing things like medicine. I love companies that are doing that, taking something that's super expensive. This was like this $20,000 piece of equipment. He's wrapping this stupid thing around my baby's toe. And I'm like, I got a sock. It said what his oxygen level was. Like, you don't need to do this. And it wasn't even built for a baby. It was insanity. And it showed how much of a better product this is, even if doctors don't want to admit that. But I think that could be the case in the future. It's got like a $400 million market cap. The fact that they kind of figured out their capital structure and they're maybe not burning quite as much money. Hopefully they become cash flow positive in 2026. I think all that's good signs for Owlet. Now we get more to the prove it phase. So I don't know. I think they've got that 10x potential, but there's also a lot of risk there too. So small position in my portfolio. I've just been riding it for a while. Thank you. Thank you, Patty. Netflix thoughts. I would love to own Netflix at the right price. I don't think. Yeah, we're at a $416 billion valuation. Price earnings multiple is 38. Here's the thing with these companies. Eventually, you'll be able to find a time when a company like Netflix trades for like 10 or 15 times earnings. I mean, Alphabet traded for 15 times earnings like 8 months ago. You go back to 2014, 2015, Apple traded for 10 times earnings. So this is one, put it on your watch list, stamp it as phenomenal company. I want to buy it if it's a no-brainer price. Eventually that moment will come around for a company like Netflix. I don't think we're quite there yet. I do not know Ava stock. But so I guess I don't have real thoughts there. Thank you. Appreciate you. Appreciate everybody who watched today. Got a couple more here. Do you have value? How do you value the humanoid robot story for Tesla? I don't know. They're one of a dozen companies making these humanoid robots. You know what? The company I want to own is Figure. If you haven't looked at them, look at theirs. Theirs looks really, really interesting. Their founder also started Archer Aviation. So really phenomenal engineering there. I would not put much value on the humanoid robot at Tesla. I know that that's contrarian to what the market thinks, but I don't value Tesla the same way. What do you think of Intel and CoreWeave short and long term? No idea. Intel, I don't know. CoreWeave, I could see that one being a good business model. I could see them being out of business in 5 years. They got a ton of debt, no proven, real cash flow. Just lots and lots of questions that I don't have good answers for. All right, I'm going to end with this. You've short stocks a couple of times. Are you seeing opportunities there? I have 3 open short positions in the asymmetric portfolio. It's called the asymmetric special situations. So if you want to know what those are, check out the asymmetric investing newsletter that's on the premium side. So you get access to all of that. But it kind of follows the idea there is, and you typically buy puts. That gives you asymmetric potential if a stock goes down without having the same kind of risk. So I can go, you can have unlimited losses if you short a stock, but if you buy puts, you can say, you know what, I'm going to put $100, $500, $1,000 into this position. I can't ever lose more than that. So the first one that I did is I shorted Tesla via long dated puts, and I believe that was January 2025. Closed that position for a 260% gain in either March or early April. So kind of when the market hit bottom. And then I added a couple of positions. I may add a couple more here in the next couple of months, but that's kind of my thinking there, and that's where you can see all of those. I'll sneak this one in. Still love Lyft and Uber. I'm buying both of them. I want to own those forever. I think they're, with autonomy, their business is going to be much, much bigger. So thank you everybody who joined. If you haven't already, check out Asymmetric Investing, asymmetric-investing.com. That's the newsletter. If you're a premium subscriber, you get access to the portfolio. Always love having these conversations. I'm going to try to do more of these. The one here on YouTube, I'll probably do the first Tuesday after the first of the month. So I would have my buys out for the month, and may try to do one on the premium side as well in between. But I really appreciate everybody joining. These are a lot of fun, but we're on now 90 minutes. I got to take a break. So thank you, and I will see you here next time.